emerging markets sold off in droves the past 3 months. Investors are fleeing as concerns swirl about slower growth in emerging economies and as the Federal Reserve sets the stage to unwind its bond purchases. The Fed bought billions of dollars worth of bonds over the past 4 years, pushing bond yields lower. As a result, investors flock to emerging markets for higher yields. And now that the Fed set the stage to begin reversing course and yields in the U.S. are rising, investors are stampeding out. Some $23 billion has flowed out of emerging market bonds since May 22nd, according to Barclays. The iShares MSCI Emerging Markets Exchange Traded Fund has lost 11% so far this year, while the S&P 500 has gained 15%. But as Baron Rothschild once said, the time to buy is when there's blood in the streets. So is it time to invest in emerging markets, or are you simply catching a falling knife? Here to weigh in is Jim O'Donnell, Chief Investment Officer for Forward Management, and Kristin Ceva, Director of Global Government Debt Strategies for Payden Rygel. Welcome to you both.
Thank you.
Thank you.
Jim, let me start with you. Is the worst of the emerging market sell-off behind us, or is there more pain to come?
Well, I think that we're going to see volatility for the next few days and weeks, but I think that the majority of the damage in terms of downside has occurred. And I think really over the next 2 to 3 months, you need to really seriously consider building positions in emerging markets to set yourself up for the next 2 to 3 years.
Of course, nobody rings a bell, right, to signal that the selling is done with these things, but what's your sense of how much more selling pressure there is to come?
Well, again, I think that there's always the risk of markets overshooting, but definitely we think that value has been created in emerging markets, both in debt and equities. And if you look at valuations now, they're very compelling. In the emerging market debt side, compare yields now to what they were in 2006. We're about the same yield, although fundamentals are quite improved in the asset class in terms of lower inflation, lower government debt, and just, I think, better credit quality overall.
Kristin, many emerging countries are raising interest rates at the expense of growth in certain cases to stem massive currency slides. So I'm wondering, do these higher interest rates draw in investors, or does it matter as the Fed potentially begins to roll back its stimulus this fall and bond yields move higher in the U.S.?
Well, I think there's certain countries that are suffering from capital outflows and certain countries that are raising interest rates. And the countries that I think are most at risk are going to be Turkey and India, that have high current account deficits, higher external financing. Indonesia, Brazil also had some challenges, but for the most part, I think you need to remember that this asset class now is 65 investable countries. And the majority of those countries are very strong macroeconomically, experiencing growth, and whose central banks are either on hold or in some cases cutting, like we've seen with Mexico today. So the universe is much wider than some of the problem countries that have been receiving most of the attention in the press.
Jim, what's your sense? Can emerging markets rally so long as interest rates are rising in the U.S.?
Yeah, I absolutely believe that that they can. I think that to Kristin's point, there's been an overshoot in terms of the market reaction to this interest rate hike. And I think that there's potentially a misjudgment of some of these global macro factors. In addition to that, we're seeing sentiment, momentum, valuation, and asset allocation really move in directions that the market isn't currently anticipating as these assets are being sold off.
Well, but Kristin, you said there are now 65 different countries that folks can invest in now, and certain countries are stronger than others. But for those that are experiencing massive capital outflows right now, I mean, how debilitating is that for those countries? You mentioned India, Indonesia is certainly one of those, South Africa, Turkey. I mean, what's the risk that we could see kind of a negative feedback loop there where folks think, okay, well, money's flowing out of the country. What's the risk that I can't get my money out? I better get out of there as well.
I think the situation that we have today is very different from 1994 when Mexico defaulted, or from 97, 98 when we saw crisis across Asia and Russia. Things have changed quite a bit in these countries since that period of time. So I don't think we're talking about default situations. We're talking about more challenging macroeconomic situations. But overall, in emerging markets, you have a number of improvements that have helped to, I think, bolster these countries in the face of challenges. And that would be the increase in FX reserves that these countries have built over time to now over 8 trillion. The fact that they have floating exchange rates instead of pegged exchange rates, that's another shock absorber, if you will. And debt to GDP has come down in many of these countries. They're in a much better fiscal situation. So yes, we're talking about in certain countries we're going to have macroeconomic challenges, but we're not talking about default and crisis in the way that we have 10 to 15 years ago or 20 years ago.
Jim, what's your sense? We've seen this movie kind of before in the late 1990s. Kristin thinks that it's different now, but what's the potential for a crisis to bubble up in your view?
Yeah, I think that oftentimes the markets kind of have this assumption of linearity, that things continue to move in a straight line. And, you know, a lot of the trade imbalances that are being cited as the reason for all of these capital flows are starting to reverse. So when you look at the export markets for somebody like Indonesia, where they're exporting heavily into Japan, Singapore, and China, you know, these things had been moving in a softer direction. And as those economies in China and Japan start to turn and improve, you're going to see those trade flows start to move back in the opposite direction. So I don't think you can project a straight line out. I think, you know, the end markets for a lot of emerging markets are really kind of Europe, Asia, and China, as well as the United States. And as we start to see a rebound in the global economy, you're going to start to see those trade flows improve materially.
Well, Kristin, to Jim's point on the trade flows, I mean, what's your sense? Our emerging markets are certainly experiencing lower growth in part because they're suffering from lower exports to the developed world as these countries recover from, you know, decades-long credit binges. But at the same time, we're also seeing certain trends like the commodity cycle peter out, and in countries like China that need to look inward for growth and discover new growth models. Do you think we're in a new era for emerging markets?
Well, I think to some extent we are, because emerging market countries like China, many countries are now moving into the more advanced stage of development, and I think it's unrealistic to expect double-digit rates of growth in countries like China that have advanced over time. I think what's happening in China now is that there's a rebalancing away from more unsustainable investment-led growth to more of a consumer-led growth pattern, and I think that that rebalancing is healthy, but certainly has been somewhat disruptive to commodity prices. But again, I think that for the most part, you have to remember that there are a number of new countries in emerging markets, or if you look at some of the African countries, you are still seeing some pretty high level growth rates there.
So then, Kristin, where are you finding value now? Which emerging markets do you like? And since you are our resident bond expert on the panel today, I mean, are you looking to corporate bonds? Are you looking to government bonds? And are you looking at dollar denominated, perhaps to guard against some of the volatility we've seen in currencies for certain countries?
Yeah, we are really looking across the board. We take a country-by-country approach and try to think through what we think are the best return opportunities across the dollar pay, the local pay, and the corporate markets. And right now, we like a number of countries that we think are on a positive structural reform path and potential upgrade momentum. Countries like Mexico, who are now in the process of implementing important reforms in energy and fiscal areas, which really slowed them down for a number of years and now can unleash, I think, higher growth as well as potential growth rates. Colombia has done a good job, particularly on fiscal reform. The Philippines as well, which we like, particularly on the currency side. And then there's some smaller countries like Costa Rica, some of the countries like Nigeria that we feel are also in good upward ratings momentum path. There are countries that we like from a rates perspective, such as Brazil, that we're a little bit more cautious about on the currency side. So in certain countries, we do hold rates hedged. Given the number of tools now in emerging market debt that can be used to express investors' views on certain markets, I think that it's now a very diverse set of rates, currencies, corporate and sovereign debt choices to make, and that allows us to express our views very specifically.
Jim, what about you? I mean, given everything we've talked about now, you do see a little bit more selling pressure, but you think we're towards the end. Do you tiptoe now into emerging markets? And if so, which markets do you favor?
Yeah, I think you have to be very opportunistic right now. Clearly, the momentum in terms of price action has changed in China, and the economic data is starting to come in with an improving tone to it. So I think that you can put dollars to work in China right now. I think that some of these countries that are really in the crosshairs of, say, the global macro sellers, such as Indonesia and Turkey, you may want to wait there before you start putting money to work. But clearly those countries that have trade surpluses, and I heard Mexico was mentioned, the Philippines as well, those are attractive areas to start putting money to work in right now.
Interesting stuff, guys. Great discussion. Thanks so much to both of you for being with us. I so appreciate it. Hope you'll come back and see us soon.
Thanks a lot.
Thank you.